Silver is down $6 from its recent high today, Western spot sitting at 80.90, and while that is happening, while paper silver is being sold down aggressively in New York, physical silver in Shanghai just moved above $93 per ounce. Surprised, a $13 premium, widening, on a day of maximum Western selling pressure. That gap is not supposed to widen when prices fall. Arbitrage is supposed to close it. The fact that it is not closing, the fact that it is getting larger on a down day, is the most important single signal in today's entire session. And it is the one number the mainstream coverage is not leading with. Stay in. We are going to build the complete picture. Silver at 80.90 feels painful if you are looking at a one-week chart. Curious? Here is what a different time frame shows. Silver is up 23.32% year-to-date. 1 year ago, silver was trading at $33 per ounce. Today it is at 80.90. And the annual average price of silver so far this year, every single daily closing price averaged together, sits at 98.66. The best annual average silver has ever recorded in its entire history before this year was last year. That figure was $41.50. This year's average is 98.66. The previous all-time best annual average was $41.50. That is the market you are sitting in right now. A $6 pullback on a Friday does not change that context. What it does is create a question worth answering precisely. What is actually driving the selling today, and does it change the structural picture underneath? Four things are hitting gold and silver simultaneously today. The dollar index has climbed above 100. When the dollar strengthens, global buyers need more of their local currency to purchase dollar-denominated commodities. That reduces demand mechanically. Silver and gold fall in dollar terms not because they are less valuable, but because the measuring stick got longer. Treasury yields have hit a 5-week high. Gold and silver pay no interest, no dividend, no yield. When bonds offer higher returns, institutional allocators shift capital toward yield-bearing assets. That is rational behavior. It puts direct selling pressure on non-yielding metals in the short term. Oil is up over 57% in the past month, moving from around $60 to above $95, touching above $100 intraday at points this week. Rising oil raises inflation expectations. Rising inflation expectations reduce the likelihood of near-term Federal Reserve rate cuts. Delayed rate cuts are not constructive for gold or silver in the paper market, and the rate cut picture right now is as delayed as it has been all year. The upcoming Fed meeting, 99.1% probability rates remain unchanged. April, no cut. June, no cut. July, no cut. September, no cut. October, the first meeting where the probability table reaches approximately 50-50. Not imminent, not soon. Potentially October at the earliest, with only even odds. Now here is where this gets structurally significant. Trump posted publicly yesterday demanding Powell cut rates immediately. Not at the next meeting, right now, as an emergency cut, because energy prices from the Iran conflict are driving inflation into the consumer. The executive wants emergency cuts. The market is pricing a 99.1% probability of no cut at all. That gap between political pressure and market reality is not a curiosity. It is the Fed trap closing in real time. The Fed cannot cut into rising oil-driven inflation without losing credibility on price stability. It cannot hike into a war-driven economic slowdown without accelerating the deterioration. And it cannot stand still indefinitely while the executive publicly demands emergency action. There is no clean exit from that room, and precious metals are caught in the crossfire of the calculus. Here is the mechanism behind today's move that the surface-level coverage is missing. When oil spikes and equities come under pressure simultaneously, funds facing losses in energy positions and equity books need to raise cash. Margin calls do not wait. The first assets sold are the ones showing a profit. Gold and silver have been outperforming, so they get sold, not because they are fundamentally weaker, but because they are the most liquid source of available gains to cover losses elsewhere. That is deleveraging, not a verdict on gold or silver, a mechanical consequence of where the profitable positions were sitting. The structural case does not change because the paper price moves lower in a deleveraging wave. What matters is what the physical market does while the paper market is selling. And today, the physical market answered that question clearly, back to Shanghai. Because this is the number that reframes everything else. Western paper silver at 80.90. Shanghai physical silver above $93, a $13 premium, on a day when Western paper is being aggressively sold. Here is why that matters more than the $6 drop. When paper prices fall, the Shanghai premium should narrow. Lower Western prices should make it easier for arbitrage traders to buy cheap metal in the West and sell it at a premium in the East. That arbitrage closes the gap. Except, It is not closing. It is widening, which means the metal is not physically available to move from west to east at the rate the premium demands. The physical supply constraint is real enough that even with Western paper prices falling, buyers in Shanghai are still paying $13 more per ounce than the COMEX price to get real metal in their hands. A widening premium on a down day is the physical market telling you the paper price is wrong, not just overpriced, but structurally disconnected from physical reality. The paper market is setting the price today, the physical market is refusing to follow it. The structural picture that existed before today's session has not changed because paper silver dropped $6. COMEX registered inventory is still at approximately 86 million ounces. Open interest is still at over 400% of that registered inventory. The 43.1% first notice day delivery rate for March contracts, the most extreme figure in modern COMEX delivery history, is still on the record. The oil-to-mining cost floor connection is still in place. With WTI above $95, silver production costs are significantly higher than they were 4 weeks ago when oil was at $60. The gold-to-silver ratio has moved back above 60-1 with gold at 5,059 and silver at 80.90. A ratio above 60-1 in an environment where the physical drain is accelerating and delivery stress is at historic extremes is not a bearish signal. It is the ratio telling you the compression has more room to run, not less. The bear case today is real, and it deserves the same precision as the structural bull case. The dollar above 100 on the DXY is direct headwind for paper metals. If it sustains above that level and Treasury yields continue rising, the institutional allocation away from non-yielding metals continues mechanically regardless of what the physical market is doing in Shanghai. The January 15, 2026 level on the dollar chart remains the critical technical reference. No sustained close above that level has printed. If one prints, the next technical objective is 150. At 150 on the DXY, paper silver faces significant additional downside pressure independent of any physical market dynamic. The 80-90 level needs to hold. If it fails on a closing basis, the next structural reference is the $79 level established during the previous Sunday flush. Below $79, the paper price has room to move considerably lower before physical fundamentals force a floor, and the rate cut timeline is not constructive. October, as the first realistic possibility for a 50-50 cut probability, means the monetary policy tailwind for metals is months away at minimum. The paper price can stay disconnected from physical reality for longer than most analysis suggests it should. The structural case being intact does not protect a leveraged position from a sustained dollar strength environment. Size accordingly. Here is what to watch through the rest of this week and into next. Watch the DXY against the January 15, 2026 closing level. That is the line. No sustained close above it has printed. If one does, recalibrate the paper metals position completely. Watch the Shanghai Premium daily. If it continues widening above $13 on subsequent sessions, the physical disconnection from paper pricing is deepening, not resolving. If it begins narrowing, arbitrage flows are finding enough metal to move. The direction of that premium tells you more about the structural reality than the COMEX paper price does. Watch the gold-to-silver ratio. Back above 60-1 today. Any compression below 58 from current levels is a directional signal that silver is beginning to outperform gold again. The move from 61 to 45 historically does not happen gradually. Ratio compression accelerates once it begins. Watch the Fed meeting next week. Not for a rate cut. The market has already priced that at 99.1% probability unchanged. Watch the language. Watch whether Powell acknowledges the oil-driven inflation complication directly. The language around future cuts matters more than the decision itself at this meeting. Here is the complete picture as it stands today. Silver at 80.90, down $6 from the recent high, dollar above 100, yields at a 5-week high. Rate cuts pushed to October at the earliest. Paper metals under pressure from 4 directions simultaneously. And yet, silver is up 23.32% year-to-date. The annual average price of silver this year sits at $98.66, more than double the previous best annual average ever recorded. Shanghai physical silver is above $93 with a $13 premium that is widening, not closing, on a day of maximum Western paper selling pressure. The structural delivery stress at COMEX has not eased. The oil-driven mining cost floor is higher today than it was 4 weeks ago. The gold-to-silver ratio at 61-1 has more compression room than it does at any point since the current cycle began. A $6 down day inside a year where silver's average daily price has never been higher in history is not the story. The $13 premium widening in Shanghai while Western paper sells, that is the story. The paper market is setting the price today. The physical market is telling you what the price should be. Watch which one is right. Verify everything. COMEX inventory reports are public and updated daily. Fed rate probability tables are published in real time through CME FedWatch. Shanghai and SHFE physical pricing data is publicly available. The data is there. The mechanics are understandable. The only requirement is the discipline to read the physical market as clearly as the paper price. Invest with logic, not hype. Market Crux, signing off.